Hey, BB, how are you?
Good. How's it going? So
Good,
thanks for
good.
jumping on the call today. Let's do it.
Yeah.
So you know where this is going. It's ending up in the course for folks, tenant to homeowners, people. It's their first home. We're trying to set them up financially, that sort of stuff. So we wanted to bring you in. Why don't you introduce yourself and we'll go from there.
Awesome. Well, my name is Keith Pitsch. I am a licensed mortgage here in the fine state of Washington and actually the whole West Coast, Washington, Oregon, and California. Been in the lending world since 1999 when I started for a major bank, US bank, and I've been in the mortgage world ever since. So my passion is really to help people understand the financing side of the coin and really through that education have the empowerment to just like go out there and make some awesome decisions about their financial future. Because I think one of the scariest things, especially in this day and age, with all the online resources where you can go look at real estate, it's really super easy to browse, but the rubber really meets the road when we start talking about financing and the mortgage.
Yeah.
So it's super fun to jump onto this course with you.
Cool. All right. Well, walk us through what it takes to get some money.
Awesome. Well, I want to break down the mortgage process in a super simple concept. And I use a recipe concept, and there's 4 ingredients that make up a mortgage. That's it, right? I'm an Italian. I love to bake and cook and do all that good stuff. And so I like the recipe approach. In the recipe for a mortgage, those 4 parts consist of your income, the assets for down payment, your credit score, and then ultimately the piece of property that you're going to buy, right? The collateral. So when we look at the mortgage, everybody comes to me like, oh my gosh, it's this big, interesting thing that I don't know much about. And I really want to break it down to those 4 simple parts. So jumping right into it, the income is really just the borrower's ability to go out there and actually afford a mortgage. Similar to tenants today, a tenant has to prove their income to the landlord. They're passing over pay stubs or W-2s or what have you. Similar process in the world of mortgages. We're going to ask for your employer's information. We're going to look at your most recent 2 pay stubs and your last W-2 for the majority of mortgages. If you're self-employed or have a business, it's a little bit different, but for the main group of folks out there buying property, it's really that simple as far as the income is concerned. What we're looking for is we're going to take that income number and we're going to boil it down to a debt to income ratio. And that will then dictate how much mortgage you can qualify for.
Debt to income ratio. That's a good term.
Debt to income ratio. That is the key. So super quick, super easy with that. The next part that we go look at is your down payment, right? And a lot of folks, we'll talk about misconceptions, so we'll come back to this. Down payments are just money in the bank, right? And so we don't jump too far ahead, that there are some huge misconceptions out there, but I just want to boil it down to this point. There are programs that have as little down as 3%. And in some scenarios, if you're buying a single family residence, you can have a 0% or 0 down loan and get in there with basically no money out of pocket. So that perception that a lot of people have, I'm sure you've heard it, BB, but a lot of people believe that you have to have 20% down. It's just not the facts.
Right.
So those assets have to be in your bank account, and they typically have to be in there for 2 months. If they haven't been in there for 2 months, we have to do a little more digging and sourcing where that money's coming from. Another untapped resource that people don't realize is down payments can actually come from relatives.
Oh, right.
It doesn't have to be their own money. If you have a relative, your aunts, uncles, grandparents, parents, what have you, if they want to give you the money for the down payment to buy your first house, that's completely acceptable. And maybe let's take a 5% down payment scenario. Maybe you have 2 or 3% that you can come up with and they just need a little bit more. You can do that little bit more. Maybe they want to give you the whole 5%. You can do that. So it's really flexible with regards to relatives. I want to be really clear. It has to come from a relative. It can't just be your golfing buddy, Jim, gave you the 5% down for your new house.
Why would your friend do that? Like, because they would just assume that you were paying that person back then.
Yeah, exactly. They would think that, well, this is going to be a private loan and you're really going to pay Jim back.
Yeah.
So that's why it's got to be coming from a relative. So income, once we get through assets, we get through credit. And the cool thing about today's world, everybody has credit karma of some sort, right?
Mhm.
So everybody knows where they're at. I think the big key takeaway is, I think the consumer public's thoughts and perception of where their credit score has to be, they think it has to be super high on the Richter scale, which is like 720, 740, or they're just not getting a loan. That is really not the fact of the matter. FHA, the Federal Housing Administration, has the most guidelines along with the VA, the Veterans Affairs. Their loans both require 620. Right? So we don't need this astronomically high credit score to allow you to buy a house. I've put multiple folks into houses that have had some, credit mishaps, or they've got a lot on a credit card and their credit score isn't what they believe at the 720 it has to be. We can go down as low as a 620 and still get you into that house. So super, super powerful. The other thing with credit that a lot of folks don't realize is how quickly after a major credit event you can get back into the mortgage world. A lot of folks that go through some hardships, maybe they claimed a bankruptcy or they had a foreclosure, what have you, they think they have to wait 7 or 10 years to get back on the horse and ride. That's just simply not the case. Right now, FHA will allow you to get back into the game after 2 years. So 2 years after a major credit event, you can jump back into it. A conventional loan, you can jump back into it after 4 years. So it's super flexible and there's lots of options. And what I always encourage folks to do, first-time homebuyers especially, is go through the pre-approval process early. Figure out what your game plan is, and those that have plans execute on those plans and they become homeowners in a very rapid way. So I would say don't be afraid of the current situation you're in, because my goal to a pre-approval with me is to figure out, if you're not credit qualified right now, what is your plan of action to get there? Is it income driven? Is it asset driven? Or is it credit driven? And then we put together a plan for the client to make sure that within the next 3, 6, 12 months down the road, they're able to execute on that plan and buy their house.
Perfect.
Yeah.
You think go get a pre-approval, even if you know that you're not going to get approved right away, get the process going so that,
Yeah, without a doubt. The devil's in the details, they say, and there's a lot of nuance in mortgage. And I always like to err on the side of caution. Here's a situation that gets everybody into trouble. A person that wants to buy a house comes to us and they're literally like 30 days away from their lease expiring. And they're like, I have to get out of my lease. I want to go buy a house. And then all of a sudden they are, maybe there's something on the credit that is holding them back. Maybe they don't make enough income right now, but they're up for a promotion or something of that nature that we could have, had we had 3 months or 6 months time forecasted for them and put together a plan of action for them, we could already have into place. So making a plan is of the utmost importance as far as where you want to go. So I always tell people that if you're 6 months away from wanting to buy a house, even if you're 12 months away from buying a house, we should have the conversation now. We should go through income. We should go through assets. We can look at credit and make sure all three of the pieces of the puzzle are ready to go. You know, the final variable as far as the collateral or the house that they buy, that's still going to be a variable until they're actually under contract. And then that brings up a whole nother set of situations that we have to deal with inspections and negotiation with the seller, which you get to handle. I don't handle that part. You guys do. But we can definitely make sure that when it comes to income, assets, and credit, the client is 100% rock solid. The three main options for clients out there as far as looking to purchase their first house. There's conventional lending, there is FA, the Federal Housing Administration, and then there's VA. And so those are what are called mortgage underwriters. So they have a little bit different parameters. Each one of them will set their credit parameters, set their debt to income parameters, set their collateral, like VA sets their type and condition of the property at a lot higher than conventional or FHA does. So they each have a little bit of nuance, and that's where the nuance comes into play, and making sure that we have the proper plan in place is that when we sit down and look at income, assets, and credit, we know exactly what collateral we can go after. We can know purchase price. We can know if we can rehab it, if we can't rehab it, if we need to make sure accessible of those things forecast out. Any change or any nuance, the structure or the collateral of a client, just the paradigm a little bit. So I have to make sure that we got common misconceptions. So I talked briefly about two of them. The first one that I cannot scream from the highest mountain loud enough is a lot of people, I do first-time homebuyer classes all the time, and I'll ask to start the class, so what is the minimum down payment requirement to buy a house? And I guarantee you the answer that I get probably 90% of the time is 20% down.
Yeah.
I just want to, if there's nothing else that you take from this section of the course, that the minimum down payment for a first-time homebuyer not using a down payment program is 3% of the purchase price, right? So that's a super powerful thing. The number one hurdle for a first-time homebuyer is the down payment. And if you understand that, it opens up a whole world of opportunity, and it changes your purchase price. Right?
Yeah.
I know lots of folks that could go out there and they could afford the mortgage payment on a $500,000, $600,000, $700,000 house, but then they're looking at a $700,000 house and saying, hey, I need $140,000 down. I can't do it because I only have 70 in the bank. I'm still 10% away.
Yeah.
And then we have this conversation and the light bulb moment happens for them. And like, I only needed 3% down. Where have I been all day?
Yeah.
Because there's huge opportunity cost in waiting, as you know, BB, but the more people can understand this and get out of the mindset of the 80s that you need 20% down, it's going to really help you jump into the market and really find the right place for your budget. I like to talk about budget. There's two words that go out in my mind when I think of budget, and budget is what I can afford and what I can qualify for. These two numbers and these two terms are completely different. So what you can budget for and what you can afford, you went through your budget. You said, hey, I want to go out to sushi once a week. I want to be able to make sure that I can go to a movie once a week. I want to make sure that I can go on a vacation once a year, that kind of thing. And you live your lifestyle. That's important to me, because this other piece over here, this what I can qualify for, this is a very interesting number, because in the mortgage world, what you can qualify for is a lot more. In a lot of occasions, it's a lot more than people want to spend, that their budget's over here for.
Yeah.
The reason being is the debt to income ratio that we talked about in the income portion. The debt to income ratio that we can use to qualify you for a mortgage is 50% of your gross income. Okay. I want to repeat that. It's 50% of your gross income. $10,000 a month, I can use $5,000 to service your mortgage and all your other debt, right? But you're not getting paid $10,000 a month, right? You're getting taxes taken out of that. You're getting your 401k contribution taken out of that. You're taking out your medical benefits, your dental benefits, and all the other things that come out of that paycheck. And you're really boiling that paycheck down to $7,000, right? So now the delta between $10,000 in your gross income and your $5,000 cap just shrank down to $2,000 worth of disposable income. Yeah. So I just want to make sure everybody realizes what you budget for is your number. Stick to your number. Super important, because last thing we want to do is over leverage you and put you into a house that you can't afford.
Right. Where are you going?
The last item that I always like to talk about is where that down payment can come from. As I alluded to, it can come in the form of a gift. Gifts can come from relatives. One other thing with the down payment, that's a very common thing. If you do have a 401k, you can take out a 401k loan against your 401k, then you pay yourself back, and then you use that money as opposed to using liquid cash. I have that conversation routinely with first-time home buyers who think they have to bring their cash to the table when they have plenty of money in their 401k, that we can leverage that 401k instead of making them illiquid. So
you take a loan out, a second loan against your 401k.
Yep.
Use it as a down payment.
Correct.
And then you have to pay back that loan plus your mortgage.
Yes, you pay that loan back through a payroll deduction.
Yeah.
So it comes out from your payroll deduction. You know, what I see typically, if you take $15,000 out of your 401k, you're typically paying somewhere between $30 and $35 a month back.
Oh, wow.
Until it's replenished. So the cool thing is you're lending against your money. Your asset in your 401k is still appreciating at that high $15,000 balance, but you just have a loan against it. So you still get the upside, the interest upside of the whole asset, but you're utilizing the capital inside of it for the purchase of your first house. It's a super powerful tool that a lot of people don't realize is there.
Yeah, that's really cool.
So, one other misconception, thinking about the 3 strategies, going down to multifamily. So many first-time home buyers don't understand that they could buy a fourplex, 4 units, and have 3 of them pay their whole mortgage as a first-time home buyer.
Yeah, and you can use the income from those other 3 units. Right.
Super powerful. I'm working with a client now, and I've worked with multiple clients in the past. And I've asked them, I said, they've come to me in a very regular fashion. They're just like, yeah, I'm ready to go buy my house, maybe a townhouse. And I said, well, you look like a person that wouldn't mind owning property and having cash flow coming in from that property, right? Becoming that investor that you speak about, BB. Yeah. And so many first-time home buyers don't believe that they are qualified to do that. Yeah. It's 100% open for you as a first-time home buyer to buy up to a 4 unit.
Yeah.
Nothing's holding you back. And guess what? The down payment on that is 3.5%. It's
the same. Yeah. So
boom.
And you can use so say you're renting out the other unit, say it's a duplex, and the one unit, you have to live in one, and the other unit is $1,500 a month rent. You get to use that $1,500 a month towards your total income, right? That's
correct. So that helps you qualify for, because typically a duplex will be a little bit higher than market of a single family residence typically. Yeah. So it will help you bridge that purchase price difference quickly and effectively. So even if, and here's another thing, even if it's vacant, say you have a vacant duplex, you're going to live in one side and the other side, we still give you credit even if it's vacant, because you know that you're going to put somebody in there.
Someone will rent it. So you just go off market rent.
We go off market rent at that point.
Okay, cool.
So super powerful. Sure, I'm going to think of others as we conclude this, and I'm going to be like, oh man.
Oh yeah, we can do it.
I can come back anytime and add more. But you know, the one thing that I always want to remove when I talk to a mortgage client is the fear around a mortgage. There's a lot of judgment that goes into it, right? Because as a mortgage professional, I'm kind of the gatekeeper. You have this passion, this motivation to go out and buy a house, and then the last thing standing between you and actually buying the house is the mortgage person. Mm-hmm. And so there's no judgment. I want everybody to know that our goal is to take you from a renter, put together a plan, whether it's right now, 3 months, 6 months, 12 months down the road, that you can buy a house. So put all that judgment aside, put all that fear of getting turned down aside. We're going to put together a plan of action for you.
Yeah, it's going to make sense.
The only variable in that action is when you can actually go make a contract, right? Some of us will come out able to make a contract. Some of us will put together a 3-month plan. Some of us will put together a 12-month plan. And as long as we follow the plan, boom, we're buying a house.